Over 9,000 option contracts on the 19 strike calls. And we are currently trading at $19 on SentinelOne, ticker symbol S. So what do these calls mean? Are they selling it? Are they buying it? In this video, we are going to analyze these unusual options that are placed May 18. It is now 3:12 p.m. These options were placed around the 1:49 p.m., 1:48 p.m. You'll see lots of these 19 strike calls for the Julys here, all coming in that time frame. So let's get right into the analysis. Based on this pricing structure and what we are looking at here, and our prior data on SentinelOne, we believe what they're doing is that they are buying the 19 strike calls. By buying this call, they are effectively increasing their break even though. So they actually, by expiration, they actually have to break this amount, which is about $21.13, because it costs about $210 just to buy one of these. And so you have to factor that in, because right now it's trading at $19. So in order to break even, you'll have to break that price point at expiration. However, unless it rises sooner, you'll see that the break even is actually closer to $19. So what we're thinking is that these calls are being bought because there's an expectation that this is going to rise sooner, because we are already at the top of a Bollinger Band here. Just like here, when it hit the top, it did stay a little bit, but whenever it's at the top, it's overextending itself, this price. And also we are over bought on the Williams percent R indicator. So there is this belief that there will be a quick upward movement soon, not necessarily all the way to expiration, because then it would have to cross earnings, have an earnings risk here for the June 1st. So there is that risk, and so we believe this is more for a bullish call in the short term, although these options were being done for the Julys, so there is that negative theta decay on it, because it's just a single call. But we don't think that it's going to be held for too long. And so for the our trade based on this, we didn't want to carry that negative theta risk. And so what we did instead was that we sold the 19 strike calls. So it is going about, there's about 2 extrinsic value by selling this. So we like to sell that. It's very optimal. And then by selling that, we went to the next expiration cycle in September, and we bought the 17 strike calls, which has less extrinsic value, just about 1.9. So we are a net seller of this extrinsic value. So we're not actually paying extra for the cost of these options. So this is what our trade looks like. We sold this call, and we bought the 17, sold the 19. And so what that does is it creates a diagonal bullish trade where our break even is actually back here. You'll see here at expiration. So we can actually hold it till expiration. It is at about $17.11. So the price can fall from $19 back here, and we would not be at a loss. And what the good thing about this trade is that we have a positive theta. It is not decaying in time, so we are not so rushed to have to take the trade off. We can let time is actually on our side, and so it's very favorable. So as time goes on, this trade is going to be profitable to become more like the blue line. So as long as it goes up higher, that is good because it will be above this zero profit loss diagram on the y-axis. As anything above that zero is profit, anything below is a loss. Okay, so our trade is actually even, it costs also a little bit less than the buying the straight out 19 strike calls. And so we also like that about it. And also if it does rally, it will be profitable as well. And so in this way, we don't necessarily have as much theta risk, and also the risk that this could actually drop back down, because if you look at the 19 strike, their break even right now is right here at 19. Anyway, anytime this price goes down, it's going to become a loss right away. Whereas our trade is not. Our trade right now, the break even is actually lower on than 19 here. And it will actually start moving this way towards this mark here. So our break even starts to get lower, so we have more room for the price to go down, which we think it's possible because we are on the upper end of the Bollinger Band, and we are also overbought on the Williams percent R. And also for earnings is coming up, so there is that risk. So we are taking a little bit more of a cautious approach to this, and not joining in on just the hype and buying the 19 strike calls like many, like these 9,000 that we saw that came in today, right? All right, so if this was helpful, please smash that like button. Helps us continue to put more videos out and share our insights. And comment below on what you think about SentinelOne. S is the ticker symbol. And subscribe if you haven't. Hit the bell icon. You'll be notified whenever we detect unusual option activity. Thank you and take care.